One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallets, VIP access, or signals, it's a scam. I sell nothing. Ever. Now type secret in the comments if you're locked in because gold hit 5,417 on the Iran war spike while silver crashed. And the reason isn't mystery manipulation. It's a war day playbook the biggest money uses every time. Rotate into the pure hedge, dump the high beta hedge, and let margin mechanics do the dirty work. Stop. This matters because today wasn't just a weird day. Today was a stress test. A test of what markets buy when they're scared and what markets sell when they need collateral. Gold is the trust hedge, silver is the friction hedge, and friction gets punished first when liquidity thins. So yes, silver can fall hard on the exact day gold is making highs. That's not a contradiction. That's the system showing you its wiring. Now I'm going to extract the material from your two sources, the Economic Times breakdown and the Rio Times daily report, and turn it into a full map. No fluff, numbers, mechanisms, and a 48-hour checklist you can screenshot mentally. Here's the setup, straight from the Economic Times. They describe a session where spot silver plunged nearly 7% intraday, while gold surged toward fresh highs during escalating US-Iran tensions. They frame the key reason as silver's dual identity. Gold is primarily a monetary safe haven, while silver is heavily tied to industrial demand. They cite roughly 55% industrial manufacturing exposure in the synopsis. Then they describe the tape. Silver briefly crossed 113, then fell to about 87.41, a Calvin 7% drop in under 2 hours. At the same time, they note gold futures surged at the open, and spot gold hit an intraday high around $415 before pulling back. Now, the Rio Times gives you the clean after-action report numbers and the institutional framing. They say gold pulled back from the weekend 5,117 war spike high and settled around 5,296, down 0.49%, while silver fell from about $90 to 84.87, down 4.98%, blowing the gold-silver ratio out to about 62.4. They even provide the full session range. Silver opened at $90.17, spiked to $91.308, then cratered to $82.913, closing $84.869, a brutal intraday range of $8.40, over 9%. So when you say silver crashed 7%, that's the intraday shock described in Economic Times. And when you say gold hit 5,417 ATH, that's the weekend war spike high that Rio Times also calls out, while also noting a separate ATH in late January on their feed. Now, here's the war secret banks use today. It's not one secret, it's a sequence that repeats in every crisis. And if you don't understand the sequence, you will keep getting emotionally farmed. Here it is. Panic hits, gold gets bought first, risk desks tighten, high beta positions get cut, silver gets sold for collateral and margin reasons, the gold-silver ratio spikes, confirming gold-only fear. Then the market decides, is this contained or persistent? If persistent, silver catches up violently later. If contained, silver keeps bleeding as industrial recession fear grows. That's the map. Now let's break down each step using your sources. Step 1. Panic hits. Gold gets bought first. Economic Times literally frames gold as the clean, safe haven response. Gold surged above $5,400 at the open as uncertainty intensified. Rio Times describes the same war premium. Gold touched near 5,107 times over the weekend on the Iran war shock. This is the first law of crisis markets. When the world feels uncertain, people buy the asset that doesn't require a growth story. That's gold. Step 2. Risk desks tighten. This is where the public loses the plot, because they think price moves are opinions. In reality, in stress regimes, price moves are often risk controls. Economic Times explicitly mentions margin calls on crashing equity indices as institutions de-risk and abandon silver positions while the gold-silver ratio jumps. Whether you agree with every dollar figure they throw out, the mechanism is correct. As risk assets fall and volatility spikes, someone needs collateral and leveraged positions get cut. Step 3. Silver gets sold for collateral and margin reasons. Economic Times describes silver hitting the psychological $100 level, then failing and triggering a cascade of selling. Rio Times gives the cleaner tape. Silver spiked to 91.31, then cratered to 82.91 before closing 84.87. Here's the line you need to remember. Gold is what people buy when they're scared. Silver is what people sell when they're forced, because silver is higher beta. It moves faster, and in leveraged markets, fast moves trigger margin pressure faster. Step 4. The gold-to-silver ratio spikes. Economic Times says the ratio surged from around 54.1 to nearly 57.1 in a single afternoon as gold outperformed. Rio Times shows it later blew out even wider, around 62.4 on their numbers, after silver's bigger drop relative to gold. This is not trivia. This is the market's lie detector. When the ratio rises sharply, it means the market is prioritizing pure safety over growth and industrial sensitivity. Gold leads, silver lags. That's gold-only fear. Step 5. The market decides, contained or persistent. Economic Times spells out the fork. Silver catches up to gold if either A, the war stays contained and industrial confidence returns, or B, the Fed cuts rates to cushion a war-damaged economy, giving silver a double boost. Rio Times frames the same fork differently. Gold's pullback was orderly. While silver's drop reflects industrial drag and recession risk, gold maintains a cleaner safe haven bid. That's the whole game. Gold is the clean hedge. Silver is the complex hedge. Now stop. Here's the trap. Most people see silver down while gold is up, and they conclude one of two stupid things. Either silver is manipulated and will explode tomorrow, or silver is broken and I should dump it. Both are emotional. Both are how the market farms you. The correct question is, was today a breakdown or a flush? And there's only one way to answer. Not with opinions, with behavior. Here's the single behavioral tell that decides everything. What happens after the slam? If silver gets slammed and stays down, buyers are absent. Bearish continuation. If silver gets slammed and snaps back fast, selling was mechanical and demand is waiting. Bullish flush. Rio Times describes Monday's silver candle as a bearish engulfing style move that wiped out prior gains and points to key downside levels around $82.44, lower band, and then the $70 zone. Economic Times calls out $72 as a key support and $120 as major resistance in its forward-looking section. So the map is clear. Silver must hold the floor zones or the unwind continues, but if it holds and rebounds, the flush becomes the setup. Now let's talk about the title claim. The war secret banks used. Here's the truth. Banks don't need a secret message. They use structure. And structure is this. When the gold-silver ratio blows out, it tells you big money is rotating into gold. Rio Times literally says the ratio blew out to 62 and that capital rotated from silver into gold within the precious metals complex. Economic Times describes the same logic. Investors choosing safety over growth as war fears hurt growth outlook and the dollar strengthens, pressuring silver. That's the secret. It's not secret at all. It's the oldest crisis behavior in finance. Buy the pure hedge. Sell the high beta hedge. Now let's make this click with one clean mental model. Gold is a seatbelt. Silver is a turbo. In a crash, people grab the seatbelt first. The turbo gets turned off until the road is stable. Then if the road stays dangerous, people want both. That's why silver can crash first and then outperform later. And both of your sources hint at that pattern. Economic Times explicitly notes silver historically catches up. Later in major crises and references prior episodes, 2008, 2020, where ratio spikes happened first. Now I'm going to add the credibility wedge here because your audience needs honesty. Economic Times includes some very specific flow numbers and bank targets, like dollar inflow amounts and specific bank targets. Treat those as reported narrative, not gospel, because those exact figures can be hard to verify across sources in real time. The core mechanisms they describe, however, match the observed tape behavior and ratio move. Rio Times also includes a lot of institutional target talk. Some of that may be commentary rather than verified official notes. Again, the most trustworthy parts are the price levels, ratio, and session range they publish. Now here's the part that keeps retention high. I'm going to give you the 48-hour war tape checklist. But first I'm going to plant 3 open loops. 1, why silver crashed exactly at $100. 2, why gold pulled back after hitting the spike high. 3, what the ratio is really telling you about the next move. We'll close all 3. Loop 1, why silver crashed at $100. Because $100 is not just a number, it's a psychological wall. Economic Times says silver briefly crossed 113 and then failed to sustain, triggering a cascade. Rio Times shows silver's ceiling in the broader recovery range. They reference a post-crash range roughly $70, $96, with $96 as a range ceiling, meaning pushes toward the high end are vulnerable to rejection. So what happened is classic. Silver ran into a psychological milestone plus range ceiling behavior. At the same time, risk desks were de-risking and margin pressure was rising. So $100 becomes the top where liquidity is available. And then the rug pulls. Loop 2. Why gold pulled back after the spike high. Economic Times describes gold surging to about 5,415s and then pulling back toward 5,310, 5,320 as profit-taking, algorithmic resistance, a stronger dollar, and rising treasury yields cooled momentum. Rio Times calls the pullback orderly and notes gold still closed above key structure levels. This is classic too. Gold spikes on panic. Then the market takes profit and reprices probability. If the war escalates, gold can surge again. If it de-escalates, gold consolidates. Loop 3. What the ratio is telling you. Economic Times says the ratio jumped toward 57 and explains the logic. Rising ratio means gold outperforms silver, risk off pure safety preference. Rio Times shows it later blew out to 62.4. The widest since mid-January on their feed, calling it the worst divergence of 2026. So the ratio is screaming one message. This is gold first fear. Silver is being treated as industrial exposure first and precious metal second. Exactly what Rio Times says. Now the question becomes, does that stay true? Because if it stays true, silver can keep bleeding. If it flips, silver can snap back violently. Now here is your 48-hour checklist. Screenshot it mentally. Gold hold test. If gold holds above the key psychological zones, Rio Times highlights $5,000 as a structural floor and cites $5,191 area as a midline support on their indicators, fear is persistent. If gold breaks down sharply, the war premium is compressing. Silver rebound speed. If silver's next slam gets bought quickly, today was a flush. If silver's next slam bleeds and can't reclaim levels, today was breakdown. Use the levels both sources give. Watch $82-$85 zone first. Rio Times points to 80 Tau 44 lower band area and 84.87 close. Then the bigger $70 zone. Rio Times $70 support, Economic Times 72. Ratio direction. If the ratio keeps climbing, gold-only fear continues. If the ratio starts compressing hard, silver is returning as a leader. Oil and inflation pulse. Economic Times notes, OPEC plus supply headlines reduced immediate inflation fears in their narrative. Rio Times lists Brent still up strongly in their macro context. If oil stays elevated, silver can eventually get an inflation tailwind. If oil collapses, silver's industrial recession weight dominates. The $100 wall retest. If silver reclaims the $87-$92 zone first, Rio Times notes $87 is a midline level and $92.829 upper band. That's your early sign the flush is ending. If silver can't reclaim those and keeps failing, the path down towards $70-$72 stays open. Now stop. Here's the punchline of your title. The war secret banks use today. It's not secret, it's a rotation. Gold is the clean hedge. Silver is the complicated hedge. When the world panics, institutions buy clean and sell complicated. That's why the ratio widens. That's why silver dumps. And that's why people who don't understand it rage post about manipulation while the smart money calmly rebalances. Now I'll close with 3 takeaways and a cliffhanger. Takeaway 1, Economic Times describes silver plunging the 7% after briefly crossing $100 while gold surged toward $5,415 because gold is the safe haven asset and silver is heavily tied to industrial demand and growth fears. Takeaway 2, Rio Times shows the next day structure. Gold pulling back from the 5,017 weekend spike to 5,296, while silver dropped to 84.87, blowing the gold-silver ratio out to 62.4. Takeaway 3, the ratio is the lie detector. When it spikes, gold is being prioritized over silver. Classic gold-only fear. If it starts compressing again, that's your signal. Silver is transitioning from collateral victim back into squeeze candidate. Here's the cliffhanger. The next time silver gets slammed, does it bounce fast? Because if it bounces fast above the $82-$85 zone, you just witnessed a leverage flush, not a collapse. And if it doesn't, if it slides towards 70-72s, then the war premium turned into recession fear, and silver trades like industrial metal first. This isn't financial advice. This is financial warfare education.